We began in the United States, where President Donald Trump's 25% tariffs on steel and aluminum imports are now in effect. The European Union treats us very badly. We are not alone in this world. We need to be closer to our allies. Prime Minister signed an agreement with the EU. We will become stronger, and we will diversify and turn ourselves towards Europe. The chill of a Quebec winter hasn't slowed the fire inside one of the world's biggest aluminum plants. Behind its towering walls, a plan has been set in motion. A $1.5 billion expansion, fueled by a powerful new energy packed with Hydro-Québec. As for Rio Tinto's Canadian operations, it's the green light on one of their most ambitious undertakings. In decades, a move that's already rippling through global markets. But while Canada was plotting its next move, a very different drama was unfolding in Pennsylvania. In front of roaring steel workers, Donald Trump promised to double steel import tariffs to 50%. We're going to bring it from 25% to 50%, the tariffs on steel, into the United States of America. Markets didn't wait to react. Aluminum prices spiked overnight. The Midwest premium surging 54% to an unprecedented high. Canada didn't flinch. Ottawa accelerated the smelter project, preparing to shift over 3 million tons of aluminum toward Europe and Asia. American factories were left to wrestle with shrinking supply while overseas buyers quietly secured. Canadian metal at rates Washington could no longer touch. Now, from smelters along the St. Lawrence to production floors in Shanghai, the ripple effect is gaining speed. Is this the moment Canada seizes a decisive lead in the metals market? Or will the U.S. find a way to claw back control before the rules of trade are rewritten? The first tremor came on July 2, 2025, when Aluminary Lowet announced a sweeping multi-billion-dollar upgrade to its Septal smelter. The project was designed to protect North America's aluminum supply, at a time when markets were already in turmoil. Since May, U.S. aluminum premiums had climbed from $860 to $1,323 per ton, a 54% surge triggered by new tariffs announced by Donald Trump. The Septiles facility, employing about 900 workers and capable of producing 620,000 tons of primary aluminum each year, secured a long-term Hydro-Québec power deal that locked in low-cost renewable energy. With it came low-carbon credits that made the smelter's aluminum more attractive to global buyers seeking cleaner production sources. In Montreal's trading circles, speculation intensified. Analysts projected Canada's low-carbon aluminum could undercut U.S. prices by as much as 20%. In Brussels, negotiators moved quietly to update side agreements that would guarantee Quebec shipments before American prices rose further. For U.S. automakers and aerospace companies, the options narrowed to paying more for materials or navigating complex channels to secure Canadian supply. Either choice risks slowing production and pushing up prices that could ripple through dealerships and airline fleets. In Ottawa, the moment became an opening by demonstrating the ability to reroute supply chains and deepen relationships beyond the U.S. Canada gained leverage in trade talks over electric vehicle incentives and green energy subsidies. Asian smelters, once reliant on its bauxite, shifted quickly to secure Canadian aluminum, directing investment toward Quebec's industry. The results strengthened Canada's foothold in both European Union and Asian markets, while U.S. producers adjusted to higher costs under the tariff regime. The effects reached well beyond metal markets. Energy companies, especially in the petrochemical sector, tracked aluminum prices as an early signal for feedstock costs. A sustained climb threatened to heighten inflation concerns and could prompt central banks to reassess monetary policy. What began as a move to protect American industry had evolved into a larger geopolitical maneuver, with Ottawa's resilience becoming a source of influence. By midsummer, attention had shifted to the strategic partnerships Canada was cultivating. Whether these new supply routes would permanently alter the metals market balance now depended on the agreements emerging in the months ahead. The financial impact had been immediate. On June 5th, U.S. aluminum premiums jumped 54% in a single day, reaching 58 cents per pound as Trump's 50% tariff took effect. The blow landed squarely on U.S. manufacturing, where Canada had supplied about 44% of aluminum imports in 2023. Within hours, Canada's Industry Minister Melanie Joly convened an emergency meeting condemning the tariffs as illegal and unjustified and promising decisive action. Canada's short-term plan included financial support for major smelters such as Rio Tinto, with discussions already underway to keep operations stable through a prolonged standoff. Smaller producers were identified as vulnerable with warnings that extended tariffs could drive some toward insolvency, putting thousands of jobs at risk in industrial towns. By July 7th, Toronto Stock Exchange futures had firmed between 0.2% and 2% as markets measured Ottawa's layered countermeasures against the growing uncertainty. On July 21st, Ottawa matched Washington's tariffs with its own countermeasures, imposing tariff rate quotas for non-free trade agreement imports, capped at 100% of 2024 volumes. By June 30th, 2025, reciprocal procurement rules were in force, locking in a framework that restricted non-preferred sources. The government backed these measures with a $10 billion tariff relief loan program for qualified businesses aimed at protecting working capital and keeping production lines moving. The strategy was designed to hold the domestic market steady, even as rising U.S. costs threatened to disrupt automotive and aerospace manufacturing. Canada also reclassified aluminum as a strategic national resource. At the North American Aluminum Summit in Montreal on June 2nd, officials announced that domestic metals would be prioritized for defense projects and critical infrastructure. The move capitalized on Canada's clean hydroelectric power, enhancing the appeal of its aluminum in tariff-free markets across Europe and Asia. The ripples spread into the energy sector. Aluminum smelters consume vast amounts of electricity, and increased production in Canada had the potential to influence oil demand patterns in the U.S. Midwest, subtly reshaping regional energy use. Ottawa's three-phase approach turned tariffs into an instrument of long-term strategy aimed at building resilience rather than offering a purely retaliatory response. Trade diversification was already yielding results. In May 2025, Canadian exports to countries outside the U.S. rose by 5.7%, reaching a record $60.81 billion Canadian dollars. Behind that number was a significant change in trade flows. Gold shipments to the United Kingdom surged by 30.1%, making precious metals one of the fastest-growing export categories. Canadian crude oil reached new buyers in Singapore. Pork exports to Japan and pharmaceutical shipments to Italy also saw major gains. These adjustments in trade routes helped offset the decline in U.S. sales, softening what could have been a much steeper overall drop. Small and medium-sized Canadian firms, from specialty pharmaceutical companies in Quebec to niche manufacturers in British Columbia, were making use of agreements like CTA and CPTP to break into new markets. Preferential access was allowing them to reduce reliance on the U.S. and strengthen their global presence. This export shift was more than an economic buffer. It sent a message that Canada would not allow itself to be boxed in by Washington's tariff strategy by cultivating a broader customer base. Ottawa shielded its industrial core, gained stronger leverage in trade negotiations, and reduced exposure to American economic pressure. Meanwhile, U.S. manufacturers continued to feel the strain of 50% tariffs on steel and aluminum. Choices remained limited, absorbed the higher costs, or look overseas, risking delays and additional expenses that could ripple through entire production lines. As European and Asian buyers secured Canadian metals at pre-tariff rates, Washington's approach risked undercutting its own manufacturing competitiveness. Canada's pivot not only safeguarded domestic jobs, but also strengthened its position as a dependable supplier in the global marketplace. The next stage of this trade war may come down to a single question: whether the United States can slow Canada's diversification drive, or if it will watch more market shares slip away. While American factories scaled back, Canada's green technology hubs pressed forward with new momentum. On July 2, 2025, the S&P Global Canada Manufacturing PMI fell to 45.6, marking the fifth consecutive month of decline. That weakness reflected the weight of the 50% tariffs and the collapse of the new export orders. Indexed to 40.2, confirmed how sharply cross-border demand had dropped. the lowest level since May 2020. Yet even as some sectors contracted, others accelerated. Ontario's EV battery component plant secured fresh investment from global automakers eager to keep supply chains outside the tariff line. Manitoba's hydroelectric projects picked up pace, attracting international green energy backers looking for tariff-safe energy sources. In 2023, the aerospace sector shipped over $19 billion worth of aircraft and parts abroad, cornerstone in Canada's plan to broaden its markets and prove its competitiveness well beyond the U.S. Quebec committed more than 700 million Canadian dollars annually to research and development, directing resources into Montreal, Saguenay, and Estrie.